Today's episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us here today to discuss what we're seeing in the market trade, which really on Tuesday's trade wasn't a whole lot. I wonder if most folks just have their mind on that Thanksgiving turkey coming up here later this week. Nonetheless, let's discuss the markets. Joining us, our good friend Brian Splitt, agmarket.net. Brian, great to have you back on the show, sir. And I know relatively quiet week, holiday shortened week, and I think this is kind of the trade that most of us expected. This is typical. Things just kind of drifting and ended up finishing a little bit lower in the grains and livestock trade for the most part on the day Tuesday, Brian.
Yeah, Jesse, it's quiet. There's really not much in the way of news right now, and so the markets will be driven by some of the short-term technical developments. I would say that on the corn market right now, we're going to be going into delivery on the December contracts next week. So next Friday is next Wednesday is first notice day. So anybody that's listening, if you're long anything in the grains, that is a December contract. So corn, wheat of any variety, bean meal, bean oil. You definitely want to be out of those longs prior to the close on Tuesday, or you do run the risk of being delivered on, which isn't really that big of a deal. It's just more of a hassle for your tax guy, if anything. But just be mindful of that. Options are going to be expiring on Friday. We do have an abbreviated session on Friday, so there will be a hard open at 8:30 instead of having night trade Thursday night. And then we will close, I believe, at 12:15. I'd have to look at my calendar again, but they're going to chop about an hour off the day, so I'll welcome that. And again, we're at the mercy of some headline risk in the meantime, in the lack of any other news. Last week we saw a pretty big move in corn and in wheat because of that report that Poland was hit by Russian missiles, which didn't actually turn out to be Russian missiles, so we took all that premium away. But I think that day on the chart is very significant. We had made a new low for the move on that day's session and then closed above the previous day's high. So we did that again 2 days later, traded below the previous day's low, closed above the previous day's high. So we've got a couple of these days where it feels like we're trying to make some kind of a low. But I would say that if December corn finds the other side of 650 here in the short term, that's not going to look good on the chart. We will likely try to fill that gap at 631 that was left in August, and that was a Monday into a Tuesday during the crop tour when we were realizing that the yields were not what we thought they might have been. So that's still going to be a target to the downside if we do push through 650. If we hold that, then maybe at best we're in a little bit of a sideways trading range where 670 is the upper end and 650 is the lower end, and we'll go through expiration of December and then focus on what's going on the March contracts. Beans had a little bit of support today early. Some concerns about what's going on in Brazil. I mean, this is 2 weeks now where we've got the unrest because of the disputes about the election results down there. And you've got the truck drivers and grain producers that are not cooperating. And so we've got the potential for disruptions in exports out of Brazil. A lot of ships are docked at those ports. So that's something that could provide fits and spurts of support. On the other end, we're waiting to see if Argentina is going to do another deal with the peso to encourage another tranche of producer selling, which could put some pressure on the market. And you look at a chart on January soybeans, and we're coiling. We're holding the short-term uptrend. We're holding the long-term downtrend, and this market's going to make a decision here pretty soon, I would think, and it's likely going to lead to a 60 to 80 cent move in whichever direction it picks, and that's going to really depend on what the driver is causing that move.
Brian, you mentioned a couple of great points there, and I want to stay on the soybean train a little bit, talk about the Brazil thing and then Argentina as well. I know right now, as it stands, I believe U.S. beans are, what, $1.40 more expensive than Brazilian beans. I think the last I looked, it was somewhere close to that number. And we also saw Chinese demand last week started to slow a little bit compared to what we've been seeing. What are your thoughts? Diving a little more into the Brazil thing, looking at the blockades there in Argentina with the peso possibilities there and Chinese demand. I mean, does it feel like the trade winds are shifting a little bit and we could see a little bit less Chinese demand here as we move towards the end of the year, Brian?
Yeah, I mean, I think if you get a sniff of dryness coming into the forecast, if you really get serious about the potential for beans to not be able to leave Brazil, then that's obviously something that could cause a rally. But we've really been harping on the idea of one of two things. Move your cash product. Especially, you had a period of time recently where futures were $1 off of lows prior to harvest. Basis was better than at the beginning of harvest. So in a lot of areas, the cash price was $1.50 better than what it was when combine started to roll. And so the recommendation was to move the product and price it. And then if you want something to the upside in case there is a South American weather development, you can use some options to do that. So I think, without the weather event happening and without major concerns about striking or continued unrest in Brazil, what eventually will happen is you're going to have this crop in Brazil that's going to be big, and we have to remember there's still tensions with the U.S. and China relative to chips and AI, and I think it's just another form of economic warfare. And so, our concern is that as we get into 2023, you really see the Chinese pull back from buying U.S. soybeans. They're going to have a fresh Brazilian crop online, and that could make the purchase of U.S. soybeans from China nearly non-existent for a good part of early 2023. So I think that's something that producers need to be mindful of for not only the crop that they've just harvested that they haven't sold yet, the portion of that crop that is still unpriced, but I think more importantly, looking at next year's soybeans, we've just tested $14 again recently. Contract highs were up around $14.48, so this is only 50 cents removed from contract highs, and I think this is something that begs to have a floor under it just in case.
Well, and you brought up a good point. I think there's already, I know we got a long ways to go before we put anything in the ground for the 2023 crop, Brian, but I'm already hearing some chatter, discussion about what farmers in the U.S. are going to put in the ground next spring. Soybeans, corn, wheat. Some of it ties back to fertilizer prices as well. So I think thinking out to that 23 crop, I know we've talked about this before, but maybe reiterate for some folks just what you guys are seeing and recommending when it comes to maybe locking in some floors, not just soybeans, but maybe corn as well, Brian.
So I think some of the things that we've done recently, and I would say one of the most common things is doing either a future sale or an HTA. In that $13.90 to $14 area, quite a bit of producers saying, I'm just going to sell some beans, called the elevator, price them at $13.90 to $14, and then maybe, if they had some concern about missing a move to the upside in the next couple months, that might have been accompanied by a $14, $16 call spread in November options. And it's just kind of one of those things where when you do the math and say, all right, well, I'm selling $13.90 beans and I'm going to spend 50 cents on a call spread. Now we got a $13.40 worst case scenario basis the futures, assuming that call spread goes to zero, which is going to take a year for that to happen. But what our intention there would be is to have a good sale on the books. If we do have a big South American crop and the bean market breaks, we're going to take off that $16 call on a move to lower values. And then we'll carry that $14 call against that sale into our own domestic growing season and see if something wonky happens. And if we can add some value to that $14 sale with that call, then great. So the idea would be to have the upside open prior to our own growing season. If the producer did not want to make a hard sale and they're more of an option hedger, then I would say a three-way in options has been pretty popular. 1340 basis November 23 beans has been a level that's been holding the last several months. So I think, if you're trying to say, hey, what put should I buy? That's the one I'm really looking at. Could you buy that put, sell a $12 put, sell a 16 call, and do that for a pretty reasonable price? That's probably if your concern is having some more upside mobility. Some producers don't want to have that sold put at $12. That's not enough downside coverage because they're concerned about China. So they're maybe more willing to have a sold call at 15 instead of 16 and just not sell a put below the market. So they've got a floor at 1340 to wherever it wants to go. And those are conversations that you have, producer to producer, and figure out, what is their priority, what is important to them, and then we structure it based on that. Looking at corn, I would say, we put out a recommendation months ago, and this is a conversation that's been ongoing. We've been really focused on February or options that expire at the end of February. So this would be March short-dated options. They are priced off of these 23 corn. And all we were really doing is buying the $6 put and then selling a call, whether it was 680 up against contract highs, $7. If you did it, maybe back in June or July, you were selling an $8 call or a $7.50 call. But our thought was, hey, let's have something in place during the month of February, because that is when we're going to make our spring average for crop insurance. 590 was our guaranteed revenue level this year. So if you could find a way to buy that $6 put and sell a call and have your cost at 10 cents, that essentially guarantees your revenue coverage is going to be no worse than it was this year. And then once we know that, we can kind of move forward with a marketing plan. And we did that on half of our expected bushels for next year. So we've been hovering above $6 here for the last couple of weeks. If we do eventually break down below 6, your major support's down at 540. And if that's where we're at come February, then we can decide whether or not we want to maintain that $6 hedge and maybe buy some calls against it prior to summer. Or if we want to just say, hey, we're making X amount per bushel, let's take the profit on that and look to sell bushels during a spring-summer rally again. But at least it offers that flexibility where you've got a little something defensive, especially for producers that have locked in inputs. Here's some of the input levels and what it's going to take to make money next year. And I think that's really the major risk for the industry as a whole is you got high inputs. And if the market breaks for whatever reason, and maybe it's not even because of corn, it's macros, you're going to have producers that are going to be potentially at a loss compared to what it takes to grow the crop. And the market doesn't care if you're making money or not.
Brian Splitt, agmarket.net, our guest today here on the show. Brian, we talk a lot about minimizing risk here on the show, and I think maybe the one sort of huge risk factor that could be in front of this entire marketplace in the weeks ahead, even with the holiday malaise trade, is the rail strike. I know it doesn't feel like that has impacted anything this week so far, as we're just getting this news more and more in. And the last week, this week, that we've got 4 labor unions that have voted no. If something doesn't happen, though, I know we've talked about this before, but it almost is, one has to wonder if this drags on and gets closer to the deadline, what impact it could have on the markets, and then what should a producer do to try and minimize some of that risk that could get thrown in the markets?
Well, you have to understand that there's risk of all sorts if that were to happen, and I'm optimistic that it doesn't. I like to think that we're just kind of getting down to the wire in these negotiation tactics, and the outcome outside of agriculture is staggering if you have rail shut down across the country. And so I think politicians and leaders across the country don't want to have this happen, and they're going to do what it takes to avoid it. But you think about basis risk. I think there's going to be flat price risk. So I think the market would see that as bearish futures. I think you're going to have the initial idea that usage is going to be impacted because of that. And again, that's a basis issue. We've seen what bean spreads did with low river levels at the Mississippi and the inability to get product out of the Gulf. So we saw, and this was while November soybeans were still on the board. So we went from a market where we were inverted, right? November was trading above Jan, March, May, July. And then you have the river issue develop, and then all of a sudden we go to a carry. And so, you're still in a carry right now, I've been looking at like March to July is near a 10-cent carry. So you've got risk in these spreads. Corn has gained, December corn has gained on March, May, and July over the last couple of weeks. If we see a concern there, and December is going to be going off the board here sooner and going into delivery next week. So, do you start to see more carry develop between March? March is trading at a premium to July. Does that go to a carry market if you start to see, concerns about rail? So I think there's different things that you have to look at, not only flat price, basis, and spreads. All three of them are going to move in directions that are not in the producer's interest.
Brian, let's talk livestock. Cattle and hog trade was fairly quiet on the day, Tuesday as well. We started higher, then kind of drifted lower. Cattle, I know we're watching Feedlot Country, trying to see if there's some activity there early this week. Not a whole lot. Had a friendly cattle on feed report Friday. What's your thoughts in this protein sector as a whole here as we near Thanksgiving?
Right, so kind of succumb to the same general holiday trade that a lot of these markets are seeing, just quiet, lower volume. But when you look at how we started the week, and you mentioned that, the cattle on feed report, we did see contracts gap higher, pulled back a little bit today, nothing major. I look at some of these deferred contracts, like your April live cattle, your June live cattle, we had gapped above resistance. So it looks good short term. I think if we can go several days and keep these gaps open, that's going to look pretty good, and maybe we can see some higher futures values. Cash has just been very, very quiet, and we'll see if there's any movement there that gives the market some more direction. But hard to expect that this week with the holiday, so maybe we'll come back out of the holiday and see a little bit more aggressive positioning on the cash side. But I think right now, if we can hold these gaps and hold some of these gains that we've tacked on here from that cattle on feed, that's going to look good for some possible higher trade in futures to come. I look at the lean hogs, and maybe the opposite. February is the contract I'm looking at right now. We've had a downtrend in the February lean hogs, and actually the highs today were right up against that downtrend. So looks like you've got really 4 solid points of against this downtrend. And if the trend is your friend, and this is a good risk reward area to look at the short side of lean hogs, potentially risking above the previous peak maybe for today. So again, if you got questions on what those price points are, give us a call here. We'll point those out to you, but it shouldn't be hard if you look at a chart and just kind of draw the line yourself there. So I see this as a downward trending market that's got some potential to move a couple bucks lower back down to some support at some lower levels. But again, we're just in that time of the year where it's hard to expect major moves unless there's something that changes, a report that changes the perception, a headline of something major happening. And we're always at the risk of some kind of a macroeconomic event that happens that causes money to flow in or flow out at any given time.
I was going to say, I got one more question for you, and I'll let you take your pick, either on the macro side, anything you're watching there, or I know crude oil's been a little volatile with just some varying headlines the last couple of days. So take your pick, anything you're seeing macro-wise or energy-wise that we want to keep our eye on here headed to the holiday, Brian?
Yeah, crude oil was volatile yesterday. We had a Wall Street Journal article that said, yeah, these Saudis are going to increase production, and then crude was down over $4, and then later in the day they said no, we're not, and then crude went back to positive at the end of the day. Finished just slightly lower. So these are, I think, in all of the markets right now, when you have a lack of news. And the grains are going to see that. Even this report in December, this is usually a very vanilla report where the USDA kicks the can and just makes their adjustments on the January final production numbers. So when you're in a lack of internal fundamental market drivers, you're going to see headlines driving markets. It's going to happen on low volume. So you could actually see some bigger moves for reasons that maybe you shouldn't make that size of a move. And there might be some good fading opportunities. Just like what we were talking about with that, the missiles in Poland, corn comes 20 cents off the lows, and here we are, right back to about a nickel off those lows. So that was a one-day move that would have been paid to be faded. So anytime you see these headlines that makes a sharp jump, you're probably going to see a quick move happen. Likely it'll be faded unless it's a really long-lasting, impactful story. But macros, I don't know. I think this whole thing in the crypto side hasn't played out yet. I think there's more entities that are at risk there, and I don't know what the exposure is from the fund manager. I think his institutional money has bought more into the crypto idea over the last couple of years. And are there more exchanges or firms to go under? Does that cascade into risk elsewhere? Maybe. But I think that's, another space worth kind of keeping an eye on.
Well, great points, great things to consider, Brian. If folks want to reach out to you and the team there at agmarket.net, they can go online or give you guys a phone call. How can they get a hold of you?
Yeah, general line 844-4AG-MARKET, so 844-424-6758. My direct line is 815-665-0463. Website www.agmarket.net, and at the top of that site is a banner for our conference that we're having in February. It'll be the 5th and 6th in Nashville, and we'd love to see you there.
Well, we appreciate the time, and with that, Brian Splitt, agmarket.net, thanks so much. We'll wish you a happy Thanksgiving, sir, and we'll talk to you again soon.
All right, likewise. Thank you, Jesse.
And that's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.